Hi everyone, in this video we'll be going over A-Level Accounting 2023 May-June Paper 1-1. This is a multiple choice paper which consists of 30 questions and each of them will be of 1 mark. The total time limit given for this paper is 1 hour, and in this video as well we'll be attempting to solve this paper under 1 hour. So without any further delay, let's get started. For the first question, we need to determine which statement describes the purpose of preparing a trial balance. So again, trial balance is prepared before preparing all of our financial statements. So the main purpose of this is to assist in the preparation of financial statements, which is given in option A. That's the correct answer. But let's have a look at the remaining options as well. The second one is to calculate owner's equity. We do not only record owner's equity as part of our trial balance. We include all of our expenses, incomes, assets, as well as liability. So this is incorrect. The third one is to calculate profit for the year. So remember that we calculate profit for the year as part of our statement of profit or loss, which is the financial statement. So essentially, our profit for the year can only be calculated after the preparation of financial statement, which is the correct answer that we've chosen for option A. So C is incorrect. Then the first one is to prove that the ledger balances are free from errors. Remember that trial balance cannot figure out all of the errors, such as the errors of omission, error of original entry, error of commission, compensating errors, and so on. So this is incorrect. Let's move towards the second question. Phil purchased new premises and made the following payments. So the cost of premises was 60,000. We have legal fees and insurance. Okay, so remember that revenue expenditures are the expenditures which will be recurring in nature. So we have to pay them time and again, whereas capital expenditures are non-recurring, which means we only have to pay them once. And legal fees is something that we only have to pay once. So this is our capital expenditure. Whereas insurance, we have to pay this every year. So this is recurring expense, which is revenue expenditure. When recording the purchase of the premises, the legal fees and insurance were both treated incorrectly. Okay, so the correct treatment would have been to include our legal fees as part of the capital expenditure and include insurance as part of our revenue expenditure. But our incorrect treatment was that we included legal fees as revenue expenditure and included insurance as capital expenditure. Phil's accounting policy is not to charge depreciation on non-current assets in the year of purchase, so we do not have to worry about depreciation in this question. We just need to figure out the effect of the errors on the profit for the year. So while calculating profit for the year, we only include the revenue expenditures. Okay, so correct revenue expenditure would have been 700, but we included 2,000 as revenue expenditure. So clearly, our overhead is overstated. And the overstatement amount will be 2,000 minus 700, which is 1,300. So if our expenses is overstated by 1,300, it just means that our profit will be understated by the very same amount. So the correct answer we're looking for is 1,300 understated for our profit, which is given in option B. Let's move towards the third question. The delivery cost of a machine purchased for business use has been included in carriage inwards. So this is the delivery cost of a machine purchased. So remember that once the machine has been delivered, it does not need to be delivered time and again, which means that we should have treated this as our capital expenditure because it is non-recurring in nature, but we included this in carriage inwards. Carriage inwards is our revenue expenditure. Now, what is the effect on the profit for the year and on total assets? So instead of including delivery cost as part of our asset, because capital expenditure should be included in the cost of the non-current asset, we treated it as revenue expenditure. So while treating this as revenue expenditure, we overstated our overhead. And whenever overheads are overstated, our profit for the year will be understated. That's given in option C and D. And instead of including this as part of our non-current asset, we included this as revenue expenditure, which means that our non-current asset was understated. So our total assets will also be understated, which is given in B and D. And the correct one for both of these is given in option D. That's the answer we're looking for. Let's move towards the fourth question. Which factors are considered when choosing the most appropriate method of calculating depreciation? The first one is benefit received over the years by using the non-current asset. That is true because essentially we're applying matching concept for depreciation, which means that we need to charge the exact same amount as part of our depreciation as the amount that we have generated as revenue by using those non-current assets. So that's definitely true. The second one is non-current asset has a clearly defined life. So remember that we calculate depreciation as cost minus our scrap value divided by the number of useful life. This is the formula for our depreciation, which means that we definitely consider the clearly defined life of non-current asset when choosing an appropriate method of calculating depreciation. So this is true as well. Then the third one is the replacement cost of the non-current asset. So replacement cost will only incorporate our carrying value or the net book value, which does not really concern our depreciation. So this is incorrect. The answer we're looking for is 1 and 2, which is given in option A. Let's move towards the fifth question. The carrying value of a company's non-current assets at the beginning and the end of a financial year is shown. This is the opening balance, this is the closing balance. During the year, non-current assets were sold for 20,000 cash, realizing a profit on disposal of 5,000. Okay, so this is the sales proceeds. And we also had our profit on disposal of 5,000. Depreciation charge for the year was 8,000. We need to figure out the expenditure on non-current assets. So this just means that we need to figure out the addition of new non-current assets. Okay, remember that our schedule of non-current assets start with the opening balance of carrying value. Then we add all of our new purchases or additions. And these will be added at cost. Then we subtract all of our disposals. And disposals will be subtracted at its net value. Then we subtract the depreciation charge for the year. Which gives the closing balance for carrying value. Okay, we have the opening balance of carrying value to be 100,000. We're trying to figure out the additions. We're given information regarding disposal, but we're only given the sales proceeds and profit on disposal. So remember that profit on disposal will happen when the sales proceeds is greater than the net book value. And the difference will be the profit, right? So our profit is 5,000. Our sales proceeds is given to be 20,000. Now we can easily figure out the net book value. That will just be 20,000 minus 5,000, which is 15,000. So we need to subtract the net book value of our disposed asset. Then we are also given the depreciation charge for the year to be 8,000. We subtract that as well, from which we get our closing carrying value. That's 80,000. Now the additions or the expenditure on non-current assets during the year will just be 80,000 minus 100,000 plus 15,000 plus 8,000, which results in the value of 3,000. This is the answer we're looking for, which is given in option A. Let's move towards the sixth question. Why would a bookkeeper make use of verification procedures? So remember that verification procedures are used in order to ensure that all of our transactions that we have recorded are free from errors. So that's the answer we're looking for. The first one is to assist in the location of errors. That's the correct one. Let's have a look at the remaining options as well to check that the accounting policies have been applied consistently. So we cannot really check for accounting policies being applied consistently using verification procedures because we only utilize the verification procedures for the financial records of 1 year. And in order to check that the accounting policies have been applied consistently, we'll have to look through the figures over the years. This is incorrect. The third one is to ensure that all transactions have been recorded. So remember that verification procedures can miss some errors, such as error of original entry or error of omission, which is what we're talking about in option C. So this is incorrect. The fourth one is to identify debts that have become irrecoverable. So irrecoverable debts cannot be figured out using verification procedures because we only consider the amount yet to be received as part of our trade receivables. In order to make sure that that amount has turned into irrecoverable debt, we need to contact that particular credit customer and figure out whether or not he will repay anytime soon. So this is incorrect as well. Let's move towards the seventh question. Douglas prepared a trial balance and found that the total of the debit column was 50 higher than the total of the credit column. The following errors were discovered. Okay, so the first one is the purchase invoice for 100 had been incorrectly recorded. The second one is an irrecoverable debt of 50 had been incorrectly recorded. We need to figure out which combination of the two errors together caused the difference in the totals. Okay, for error 1, we have recorded in purchase journal at 50. So we're talking about journal, which means that this is the error of original entry, and such errors will not be reflected in the trial balance, so we do not need to consider this factor. The second one is both entries reversed. So the second error was irrecoverable debt. So our correct entry would have been to enter the irrecoverable debt as expense on the debit side and subtract the same amount from the trade receivables on the debit side itself. If we reverse these both entries, then it just means that we will be recording 50 as income on the credit side And we will again be adding 50 to our trade receivables on the debit side. So the total will be equal. There is no differences in the total. So option A is incorrect. For option B, for error 1, we have recorded in purchase journal at 50. Again, this is error of original entry, which we do not need to consider because this will not be reflected in our trial balance. The second one is not recorded at all. So if we do not record the irrecoverable debt of 50, it just means that it will have no effect on either the debit or the credit side. So the total will still remain the same. The debit column will not be 50 higher. This is incorrect. The third one, for the first error, we have recorded in sales journal rather than purchases journal. Again, this is the error of original entry, which will not be reflected in our trial balance, so you can ignore this. And error 2 is recorded in expense account only. So if we only record it as expense account, that will be on the debit side, but not subtract the same amount from trade receivables, then it just means that our trade receivables will be overstated by 50. And trade receivables is posted towards the debit side, which means that our debit side of the trial balance will be overstated by 50, which is the exact thing that we're looking for. The correct answer is given by option C. Let's have a look at the fourth option as well. For the first error, it's recorded in sales journal rather than purchases journal, which is error of original entry. We do not have to consider this because this will not be reflected in the trial balance. For error 2, we have recorded in sales ledger account only. So it means that our trade receivables, we subtracted 50, but we did not include 50 as part of our expense on the debit side. So our debit side is actually understated by 50, but we're looking for debit column 50 higher, not debit column 50 lower. So option D is incorrect. Let's move towards the eighth question. When preparing a bank reconciliation statement, which item is an uncredited deposit? So uncredited deposit refers to all of the deposits or the receipts that have not yet been cleared by the bank. This is the answer we're looking for. For the first option, we have a check to a credit supplier. So this is deposit. We're not providing any sort of payment, and a check to credit supplier would mean that there is a payment. So this is incorrect. The second one is a credit transfer from a credit customer. So this is a receipt not yet recorded in the cash book. So the first part is correct because we're talking about a deposit, and this is not yet recorded in the cash book. But we're only talking about deposits not yet cleared by the bank. So second option is also incorrect. The third one is an amount charged by the bank. So the amount charged by the bank would mean a payment, but we're talking about deposit. This is incorrect as well. And the fourth one is an amount paid into the bank, which is the deposit, not yet recorded on the bank statement, which means that this is the amount not yet cleared by the bank, which is what you're looking for. So that's the correct answer. Let's move towards the ninth question. A company received its bank statement dated 30 June showing a credit balance of 6,890. Credit balance means a positive amount. The cash book on this date had a debit balance of 7,234. Cash book debit balance is also a positive amount. The following items were discovered. We need to figure out the figure which should be used for bank in the statement of financial position. So we're trying to figure out the correct bank balance. Okay, so let us calculate the correct bank balance from both our balance as per the bank statement of 6,890 as well as the balance as per our cash book of 7,234. We will rectify both the errors and we should arrive at the same figure. Bank charges of 54 had not been entered in the cash book. So we need to show 54 as an expense in the cash book. So our amount will decrease because we're making a payment of 54. The second one is deposits made to the bank on 30 June for 490 had not been shown on the bank statement. This is the deposit. So this is the amount that we received, which we need to show in the bank statement. So we'll be adding 490 into our balance as per the bank statement. Then suppliers had not banked checks for 200. We're talking about suppliers in this case, which means that they are the party to whom we pay the amount. So we have already paid 200 in check, right? So this will already be recorded as payment in our cash book. We do not have to rectify that part, but this has not yet been banked. So for our bank statement, this clearly is not included as part of our payment because these are the uncredited checks. So we need to show this as an expense in our bank statement as well. Let's figure out the total for our bank balance. From the bank statement, that will be 6,890 plus 490 minus 200, which is 7,180. And from our balance as per the cash book, that is 7,234 minus 54, which again results in 7,180. That's the correct answer we're looking for, which is given in option D. Let's move towards the 10th question. Where is discount allowed recorded? So remember that discount allowed is an expense. Okay, so if you're talking about cash book, then discount allowed will be recorded on the debit side. That's given in C and D. If you're talking about discount allowed account, again, that will be recorded on the debit side because that's an expense, which is given in B and C. And in our sales ledger control account, discount allowed will be recorded on the credit side. So that is given in A and C. So the correct one for all three is given by option C. Let's move towards the 11th question. The closing balance on a sales ledger control account was 10,150. We are given some errors. We need to figure out the total of the individual sales ledger balances before the correction of these errors. Okay, so we start with our balance as per the sales ledger control accounts. That's 10,150. The first error is that a sales invoice for 270 had been correctly entered in the sales journal but posted to the customer's account as 200. So our customer account only includes 200 and not the remaining 70. Right? But this 70 is included in this balance. And since we're trying to figure out the balance before the correction, we need to exclude this 70 from the amount of 10,150. So we're just subtract it. For the second error, goods returned by a credit customer for 90 had not been entered in the sales returns journal. So if this transaction had not been recorded in the sales returns journal, it means that this transaction will also not be reflected in the sales ledger control account. So we do not have anything to rectify for the second error. The total is just 10,150 minus 70, which results in 10,080. That is the total of the individual sales ledger balances before the correction of these errors, and it's given in option B. Let's move towards the 12th question. A company undervalued the closing inventory for its current accounting period. How did this affect gross profit? So remember that the formula for gross profit is we subtract the cost of sales from sales, right? And in cost of sales, we include opening inventory plus purchases minus closing inventory. So if we open this bracket, we can see that it's going to be sales minus opening inventory minus purchases plus closing inventory. So what we can see is that when figuring out our gross profit, we add our closing inventory. But we're talking about undervaluation of closing inventory in this case. So if our closing inventory is undervalued, then it also means that the gross profit for the current period will be undervalued. That's understated, which is given in option B, C, and D. Then for the following period, the current inventory of this period will act as the opening inventory for the next period, right? So we're looking at opening inventory now. We subtract opening inventory in order to figure out the gross profit. So if our opening inventory is understated, then it just means that our gross profit will be overstated. So the gross profit for the following period will be overstated, which is given in option B. So the correct answer is given by option B. Let's move towards the 13th question. Draft financial statements for a business showed a profit for the year of 62,000. The following errors were discovered. What was the corrected profit? We start with our draft profit of 62,000. Let's have a look at the first error. Accrued loan interest payable of 3,900 had not been accounted for. Loan interest payable is our payment which we need to subtract in order to figure out the profit. So we just need to subtract that 3,900. For the second one, allowance for irrecoverable debts had been overstated by 4,800. So if this has been overstated, we definitely need to subtract this. But allowance for irrecoverable debts is something that we subtract in order to figure out the profit. So that's a double negative which results in a positive. It just means that in order to rectify this error, we have to add this amount of 4,800. For the third one, depreciation was found to be understated by 7,500. If it's understated, we definitely have to add it. But we're talking about depreciation, which you need to subtract in order to figure out the profit for the year. That's a positive and a negative, which results in negative, which just means that we need to subtract this amount of 7,500 in order to rectify this error. Then for the fourth one, prepaid rent expense of 2,600 had not been accounted for. This is a rent expense, which we definitely need to subtract. And we're talking about prepaid rent. Prepaid rent should not be included as part of our rent expense for the year. So we have to exclude this, which is again a subtraction, and double negative make a positive. So in order to rectify this error, we just need to add this amount of 2,600. So that's plus 2,600. Okay, so our corrected profit for the year is just going to be 62,000 minus 3,900 plus 4,800 minus 7,500 plus 2,600, which results in 58,000. That's given in option C. Let's move towards the 14th question. Joe is a sole trader. Which statements relating to his business are not correct? The first one is that Joe can receive a bank loan for the business. So remember that a sole trader can definitely receive a bank loan. So this is a correct statement. Joe's drawings are transferred to his capital account. Again, this is true as well, because remember, for a sole trader, we add all of the profit for the year to the opening capital balances and we subtract all of the drawings from the opening capital balances in order to figure out the closing capital balance. That's the correct statement. The third one is Joe's personal expenses are included in his statement of profit or loss. Remember that personal expenses are definitely not included in the company's statement of profit or loss for a sole trader. This is the incorrect statement that we're looking for, and 3 is given in option D. That's the correct answer. Let's move towards the 15th question. The owner of a business does not keep a full set of accounting records for his business. The following information is available about assets and liabilities. So this is the current year end, which is the closing balance. This is the previous year end, which is the opening balance. Alright, all purchases and sales are on credit. Let's have a look at the question. We need to figure out gross profit for the current year. Okay, so during the year, the business received 168,000 from customers after allowing them a discount of 3,400. Okay, we definitely need our figure for sales. So let's start with the amount that we received from customers. That's 168,000. Then we need to incorporate our trade receivables. So we have our opening balance of trade receivables to be 22,400. Remember that this is the credit sales that we made in the previous year, which should not be included as part of our sales in the current year. So we'll subtract 22,400. Then we have closing balance trade receivables of 31,200. So these are the credit sales that we made in this particular year but have not received the amount yet, but this should definitely be included as part of our sales. So we're just going to add this amount of 31,200. Then we also have a discount. And remember that in our statement of profit or loss, we include our discount allowed as part of the overhead in the later section. So it definitely should be included as part of our sales first. So that's 3,400. This gives the total of our sales to have the value of 180,200. Then the business paid 74,000 to suppliers for inventory. No discounts were received. Okay, we can figure out purchases from this one. We'll start with the amount paid to suppliers, that's 74,000. Then we need to incorporate the trade payables. So we have our opening trade payables of 16,600. So this amount reflects the credit purchases that we made in the previous year, which should not be included as part of the purchase in the current year. So we're subtracting this amount. Then we have our closing balance trade payables of 14,300. So these are the credit purchases that we made in the current year, which needs to be included as part of the total purchases. So we're adding the 14,300. This gives our total purchases to be 71,700. Now we can easily figure out gross profit. So our formula is just sales minus cost of sales. We have our sales to be 180,200. Let's figure out cost of sales. That is just going to be opening inventory plus purchases minus closing inventory. We have our opening inventory to be 17,500. We have purchases to be 71,700. And we have the closing inventory to be 19,200. This gives our cost of sales to be 66,800. So our gross profit for the year is 180,200 minus 66,800, which is also 113,400, which is given in option D. Let's move towards the 16th question. A partnership agreement includes the following provisions. Which provisions will result in entries in the partnership's appropriation account? So interest on capital is subtracted in our appropriation account, so that's true. Interest on drawings is added to our appropriation account, that's true as well. Interest on partners' loans will already be adjusted in our statement of profit or loss. So this will not be included as part of our partnership's appropriation account. The correct answer is 1 and 2, which is given in option B. Let's move towards the 17th question. The partnership agreement of X and Y stated that interest on capital should be calculated at the rate of 10% per annum. At the beginning of the year, on 1st January, the balances on X's accounts were capital 50,000 and current account 2,000 debit. So this just means that X will owe 2,000 to the partnership business. On 1st July, X contributed additional capital of 20,000. On 31st December, the balance on X's current account was 20,500 credit. He had made no drawings. We need to figure out X's share of the residual profit for the year. So let's prepare X's current account. We can start with the opening balance of 2,000 debit. So if this is 20,500 credit and we have to show it as a credit opening balance, then it just means that for closing it will be on the debit side. Okay, then we have our interest on capital, that's 10%, right? But remember that the interest on capital for 50,000 we have to charge it for the entire year, but for the additional capital of 20,000 it was only introduced in July. So we need to calculate the interest on capital for this 20,000 for the months of July, August, September, October, November and December. So that's for 6 months. Let's figure out the interest on capital. For 50,000 we need to calculate it for the entire year, so that will just be 50,000 times 10%. But for the 20,000, that will be times 10%. This will give the interest on capital for the entire year, but we have only utilized the capital for 6 months, so that's times 6 by 12. This gives the total interest on capital to be 6,000. And interest on capital is something that the partners will receive from the partnership, so this goes towards the credit side. Alright, then we need to figure out the residual profit, which is also something that the partners will receive from the partnership, which will go towards the credit side. Now, in order to figure this out, we first require the total. So let's figure out the total from debit side. That's 20,500 plus 2,000. That will be 22,500. Now, in order to figure out the residual profit, we just need to subtract this from total. That's 22,500 minus 6,000, which results in the value of 16,500. That's the correct answer we're looking for, which is given in option C. Let's move towards the 18th question. The following actions took place in respect of a limited company. We need to figure out the increase in the company's total equity. Okay, so a transfer of 50,000 was made from retained earnings to general reserve. So this will have no effect on company's total equity, because remember that the 50,000 will be subtracted from our retained earnings and the same 50,000 will be added to the general reserve. So the total change is 0. For the second one, an issue of 200,000 ordinary shares of 1 each at a price of 2.50 was made. So this will definitely result in the increment of our company's total equity. That will be by 200,000, that's the number of new ordinary shares, multiplied by the rate of new ordinary shares, that's 2.5. This results in the value of 500,000. Then for the third one, we have non-current assets with a carrying value of 1,250,000 were revalued at 1,500,000. So this is revaluation upwards, which will definitely lead to an increase in the company's total equity. So that will be by 1,500,000 minus 1,250,000, which results in the value of 250,000. Then for the fourth one, ordinary dividends of 100,000 were proposed. Proposed dividend will have no effect in our total equity. So the total increment will just be 500,000 plus 250,000, which results in 750,000, which is given in option D. Let's move towards the 19th question. Gordon sells goods on credit to Sybil. Which information from Sybil's financial statements is of greatest interest to Gordon? So if Gordon is selling goods on credit to Sybil, so Gordon will definitely be interested in the liquidity of the company. So we're looking for liquid ratios such as our current ratio or acid test ratio, and we're given current ratio in option A. That's the correct answer. Let's move towards the 20th question. Which actions would in general improve the acid test ratio of a business in the short term? So the formula for acid test ratio is our current asset minus closing inventory divided by current liabilities. So for our acid test ratio to improve, we require the current asset to increase, or the closing inventory to decrease, or the current liabilities to decrease. So we're looking for these three things. The first one is delaying trade payables. So if we delay trade payables, then our trade payables will remain as part of the current liabilities in our ratio as well. So the first one is definitely incorrect. The second one is selling inventory. If we sell inventory, then it just means that our closing inventory will decrease, which is what we're looking for. That's the correct one. The third one is selling surplus non-current assets. If we sell surplus non-current assets, then we will receive cash. Cash is a part of current asset, and the receipt of that cash will definitely increase the current asset. So the third one is correct as well. Then the fourth one is trade receivables paying their debts. This will have no effect on our current asset, because if our trade receivables will pay their debts, then it just means that trade receivable will decrease by the same amount by which our cash will increase. So this will have overall zero effect on our current assets. So that's incorrect. We're looking for 2 and 3, which is given in option B. Let's move towards the 21st question. A business had current liabilities of 4,000 at its year end. Asset test ratio was 1.5 to 1. Current ratio was 2.25 to 1. We need to figure out the value of inventory held at the year end, which is the closing inventory. Okay. So for asset test ratio, our current asset minus closing inventory divided by current liabilities is given to be 1.5 because that's the value of asset test ratio. We have our current liabilities, so the current asset minus closing inventory divided by 4,000 is 1.5. This just means that our current asset minus closing inventory will be equal to 1.5 times 4,000, which is 6,000. Then we have our current ratio, that's 2.25. And the formula is just current asset divided by current liabilities equals to 2.25. We can substitute the value for current liabilities, that's 4,000 equals to 2.25, which gives the value for our current assets to be 2.25 times 4,000, which is also 9,000. So we're going to substitute this value into this equation. So that's 9,000 minus closing inventory will be equal to 6,000, which gives the value for our closing inventory to be 9,000 minus 6,000, which is 3,000. That's the correct answer we're looking for, which is given in option A. Let's move towards the 22nd question. The following information is available for a company for its year ended 31st December. Alright, we need to figure out the return on capital employed. The formula is profit from operations divided by capital employed multiplied by 100%. Okay, we're given profit from operations right here, that's 84,000. Now let's figure out our capital employed. Capital employed is our equity plus non-current liabilities. Okay, this is non-current asset, current liabilities, interest paid. We have share capital, which is part of the equity, that's 200,000. We have total reserves, which is again part of our equity, so that's 157,000. Then there's non-current liabilities, so that's plus 130,000. This gives the total for our capital employed to be 487,000. So our return on capital employed is just going to be 84,000 divided by 487,000 times 100%, which is 17.25%. That's given in option B. Let's move towards the 23rd question. An employee is paid at the hourly rate of 20 basic pay for working 8 hours a day. Overtime is paid at the hourly rate of basic pay plus 25%. So that is 20 times 1 plus 25%, which results in 25. Then a productivity bonus is also paid at the hourly rate of basic pay plus 50%. So that's 20 times 1 plus 50%, which results in 30. For every unit produced more than 30 units per day, on Wednesday, the employee worked 10 hours and produced 32 units. What was the employee's gross pay for Wednesday? So the employee will get 20 per hour for 8 hours. So that's 8 times 20. Then for overtime, hourly rate is 25. So the extra hours that he worked is 10 minus 8, that's 2. So for 2 hours, he'll get 25. Then he'll also get 20 per unit for units produced more than 30 units. So the more units is just, that's 32 minus 30, which is 2. So for extra 2 units, he'll get 30. And this gives 160 plus 50 plus 60, which gives a total of 270. That's the correct answer, which is given in option C. Let's move towards the 24th question. Julia is a retailer of electronic equipment. She decides to introduce a system of just-in-time inventory management. Which benefit can she expect from this? So just-in-time inventory management just means that we buy all of our required raw materials or inventories at the time right before the production process. So we do not really store all of the materials. We buy it at the time of need. Let's have a look at the first option, to be able to take advantage quickly of product improvements. So this is the correct answer, because if there is product improvement and we require a new kind of inventory, then just-in-time inventory management will be the best option, because we can just purchase a new inventory or new raw material before the production process of our new product or improved product. Let's have a look at the remaining options as well. The second one is to increase the amount of trade discounts she can receive. So just-in-time does not really talk about any bulk purchases, so we cannot be sure regarding the trade discounts. This is incorrect. The third one is to limit the effect on her profit of price rises by the manufacturer. Again, for just-in-time inventory, we do not store inventory in bulk. We do not really store it. We only buy it at the time of need. So we cannot really prevent ourselves from the price rises by the manufacturer. This is incorrect. Then the fourth one is to protect herself better from shortages of goods to sell. Again, remember, just-in-time inventory management will not hold inventory in bulk. So she definitely cannot protect herself better from shortages of goods to sell. This is incorrect. Let's move towards the 25th question. Justine is an accountant and charges her clients a fee at an hourly rate plus overheads. She adds a markup of 20%. The following budgeted information is available. We need to figure out how much will Justine charge a client for a job which takes 20 hours to complete. So we're given the annual hour worked, annual overhead expenditure, direct labor rate per hour, extra charge if job is greater than 15 hours, and overheads are charged on a direct labor hour basis. So let's figure out the overhead per direct labor hour. We just have to divide our total annual overhead, that's 56,350, by our annual hours worked, which is 1,610. This gives our overhead per direct labor hour to be 35. Okay, let's calculate the cost for the job. So the number of hours worked is 20. We can just multiply it by the direct labor rate per hour, that's 45. Then our overhead is also based on the number of hours worked. So that will be 20 times overhead per direct labor hour of 35. And there is an extra charge if job is greater than 15 hours. And this job is of 20 hours, so we need to add this as well. So that will be plus 200. This gives the total cost to be 1800. But remember that she also adds a markup of 20%. So we need to increase this by 20%. This gives the correct cost to be 2,160, which is given in option C. Let's move towards the 26th question. Which statement describes the purpose of overhead apportionment? So remember that overhead apportionment is done so that we can share the cost of our service departments to production departments. Let's have a look at our options. The first one is to assign specific cost to production departments. So remember that we do not assign specific cost. We assign the common cost. So this is incorrect. Option B is incorrect as well. The third one is to share common costs. That's correct. To production departments. That is also correct. And option D, we share common costs. That part is correct. But this is to service departments. That's incorrect. Overhead apportionment is always done to the production departments. Let's move towards the 27th question. A business has two production departments, machining and assembly. The budgeted direct labor hours for each department are as follows. Alright. The business has calculated overhead absorption rate as follows. Insurance of 4,800 relating to the assembly department was incorrectly omitted when making the calculations. We need to figure out the correct overhead absorption rate for the assembly department. Okay, so remember that we calculate our overhead absorption rate by dividing the total overheads by our either the machining hour or labor hour. And in case of assembly, it's based on the direct labor hour. So we're given the previous overhead absorption rate to be 7.70. We're trying to figure out the total overheads. And we're given the direct labor hours for assembly department to be 16,000. So this gives the total overhead for our assembly department to be 7.7 multiplied by 16,000, which results in 123,200. And remember that we omitted insurance of 4,800. So we also need to add this. Now the correct total overhead is going to be 128,000. Now let's figure out the correct overhead absorption rate. That will be our total, which is 128,000 divided by the number of direct labor hours, which is 16,000. This gives the value of 8. That's the correct answer, which is given in option C. Let's move towards the 28th question. Which statements about marginal costing are correct? The first one is it only uses fixed and variable cost in calculation. So for marginal costing, all of our calculations are based on variable cost. This is incorrect. The second one is it only uses variable cost in calculations. That is correct. The third one is it should only be used for long-term planning decisions. This is incorrect because marginal costing should be used for short-term planning decisions, which is given in fourth statement. So the correct ones are 2 and 4, which is given in option D. Let's move towards the 29th question. A business makes and sells a single type of product. The following information is available. We are given the selling price, direct material, and direct labor per unit. The business also has a semi-variable overhead associated with this type of product. The overhead is 32,000 when output is 20,000 units, but rises to 40,000 when output is 40,000 units. Okay, so we just need to figure out the variable cost as well as the fixed cost for this. For 20,000 units, that's going to be 20,000 times variable cost per unit plus the fixed cost. This will result in 32,000. For 40,000 units, that's 40,000 times variable cost per unit plus fixed cost, which results in 40,000. Let's subtract the second equation from the first one. That will be 20,000 minus 40,000, so that's minus 20,000 variable cost. Fixed cost will get cancelled. Then we have 32,000 minus 40,000, that results in negative 8,000. This gives our variable cost per unit to be 8,000 divided by 20,000, which results in 0.4. Now let's figure out the fixed cost. We can use the first equation, so that will be 20,000 times 0.4 plus our fixed cost. This will be equal to 32,000. So our fixed cost is just going to be 32,000 minus 20,000 times 0.4, which results in the value of 24,000. Now we need to figure out the break-even point. The formula is fixed cost divided by contribution per unit. So our fixed cost is 24,000. For contribution, we just need to subtract all of our variable costs from the selling price. So that's 10.8 minus 2.2 minus 4.2, and we also have additional variable cost of 0.4. This gives the contribution per unit to be 4. So our break-even point will be 24,000 divided by 4, which is 6,000 units. This is given in option B. Let's move towards the 30th question. What is the purpose of cost volume profit analysis? The first one is to compare actual and budgeted cost. This is not something that we do under cost volume profit analysis. This is done under standard costing. The second one is organizing resources in the most efficient way. This is also incorrect because we do not really consider organizing resources. This is only done when we have limited resources as part of our marginal costing. The third one is planning to achieve targeted profit, which is correct because we consider all of our costs under different volume or different level of activities and figure out the most optimum profit. Then the fourth one is preparing annual financial statements. Cost volume profit analysis will not really help in preparation of financial statements, so this is incorrect. This concludes the paper 11 for 2023 May-June. If you found this video useful, make sure that you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.